Monday morning, you walk into your bank to make a routine deposit, same account you've had for years, same ID you've used dozens of times. But this time, the teller pauses, types something, pauses again, then says those words that make your stomach drop just slightly. We'll need to hold this for 72 hours for verification. No fraud alert, no suspicious activity, no accusation, just verification. You ask why. The answer comes back clean and professional. New ID verification procedures for your protection. But here's what's eating at you as you walk out. Nothing about your ID changed. Nothing about your account changed. So what changed on Monday that didn't exist on Friday? If you felt that friction, that sudden pause where routine becomes uncertain, you're not imagining it, and you're not alone. By the end of this video, you'll understand exactly how bank rules shift without announcement, why compliance friction appears before any system actually breaks, and what happens to trust when procedures quietly drift away from what people expect. This isn't about bank failures. This isn't about accounts getting frozen or fraud investigations. This is about something more subtle and potentially more destabilizing. The moment when rules people rely on stop behaving the way they used to. Let's start with what most people believe when this happens. The reasonable story goes like this. Banks have to follow regulations. Those regulations change. When they change, banks update their procedures to stay compliant. Sometimes that means extra verification steps. Sometimes that means longer processing times. It's about security. It's about protecting customers from fraud and identity theft. This explanation sounds completely logical, responsible even. Think about it. You want your bank to verify identities, right? You want them to catch fraudsters before they access accounts that aren't theirs. You want robust security measures, especially in an era where financial crime is increasingly sophisticated. So when a teller explains that your routine transaction now requires additional verification, part of you nods along. Of course, they need to be careful. Of course, security matters more than convenience. The story makes sense. Banks follow rules. Rules exist for good reasons. Following rules protects everyone. But here's where that reasonable story starts to crack. If this was really about new regulations, why didn't anyone announce them? Why didn't you get a letter explaining that starting Monday, certain transactions would require additional verification time? Why didn't the bank's website update their processing time estimates? More importantly, why does this feel less like enhanced security and more like friction? Because when you really think about it, your ID didn't become less secure over the weekend. The verification technology didn't suddenly become less reliable. Your account history didn't become more suspicious. But this still doesn't explain where the real damage begins. To understand what's actually happening, you need to see how bank compliance really works. Most people think of bank rules like traffic laws, posted speed limits, stop signs, clear, written regulations that everyone follows the same way. But bank compliance is more like airport security. Think about the last time you flew. The basic rules haven't changed much in years. No liquids over 3 ounces, shoes off, electronics in bins. But somehow the line moves differently every time you travel. Sometimes the TSA agent waves you through quickly. Sometimes they examine every item in your bag. Sometimes they run additional scans. Sometimes they don't. Same rules, same equipment, same security goals. But the application varies. Bank compliance works the same way. There are written regulations, yes. But there's also something called supervisory guidance and examination priorities and enforcement trends. These aren't laws. They're interpretations of laws, suggestions about how to apply laws, signals about what regulators are paying attention to this quarter. Hold on to this. It matters later. When a bank receives new supervisory guidance, they don't just update their policy manual and move on. They update their procedures, their training, their software systems, their approval workflows. But here's the key part most people never see. They also update their tolerance for risk. Let's say the guidance suggests that banks should enhance customer verification procedures during periods of increased fraud activity. That's not a specific rule. That's an interpretation, a suggestion, a nudge. But to a bank's compliance department, it might as well be a direct order. Because banks don't get rewarded for taking compliance risks, they get punished heavily. So when guidance suggests enhancement, banks enhance. When it suggests additional verification, banks add verification steps. This part sounds small, but it isn't. The result is what we call rule drift. The written regulations stay the same, but the applied procedures quietly shift. More documentation required, longer processing times, additional approval steps, extra verification periods. None of this gets announced because technically nothing has changed. The bank is still following the same core regulations they always followed. They're just following them more carefully. Now here's where this gets uncomfortable and why you need to stay with me through this next part. Rule drift doesn't happen in isolation. It spreads. When one bank adds a 72-hour verification hold, other banks notice. They start asking themselves, are we being careful enough? Are we following guidance closely enough? What if regulators think our verification procedures are too loose? So they add their own holds, their own additional steps, their own enhanced procedures. Within weeks, What started as one bank's interpretation of guidance becomes industry standard practice, not because of any new law, not because of any specific threat, but because caution spreads faster than clarity. Most people never see this step. Let me give you a real-world example of how this plays out. Imagine you run a small business. Every Friday you deposit the week's cash receipts. It's routine, predictable. The money clears over the weekend, and Monday morning you can access it for payroll, vendor payments, operating expenses. But now suddenly, that Friday deposit triggers a verification hold. 72 hours minimum. Maybe longer if the weekend includes a holiday. Your payroll doesn't wait for verification. Your vendors don't pause their payment expectations. Your operating expenses don't disappear because your bank decided to enhance their procedures. So you adapt. You start depositing earlier in the week. You keep larger cash reserves. You build buffer time into your payment schedules. These adaptations work. Your business continues operating. No crisis, no failure, no dramatic breakdown. But something has changed. Your routines now include uncertainty. Your cash flow planning now includes buffer time. Your relationship with your bank now includes doubt about timing. Stay with me. This connects in a way most people never see, because you're not the only one adapting. Every business banking at that institution is making similar adjustments. Every individual customer is building similar buffers. Every routine transaction now carries a small question mark about timing. The system still works, money still moves, accounts still function, but the predictability that makes financial systems useful has quietly eroded. Here's the part people miss when they think about how financial stress spreads. They imagine it starts with big, obvious failures. Bank runs, credit freezes, market crashes, dramatic headlines about institutions collapsing, but that's not how it actually begins. First, procedures slow down. Verification takes longer, approval processes add steps, documentation requirements expand. What used to take minutes now takes hours. What used to take hours now takes days. Then people start adapting their behavior. They plan for delays. They keep extra cash on hand. They submit paperwork earlier. They avoid transactions that might trigger additional review. Only after that do you see the psychological shifts. Confidence becomes conditional. Trust becomes qualified. People start asking questions they never asked before. What if this takes longer than expected? What if they ask for additional documentation? What if the rules change again? But this still isn't the final break. The last stage is the one nobody prepares for, because it doesn't look like a financial problem at all. It looks like a communication problem. When rules drift, institutions stop being able to give clear answers about timing. They can't promise that your transaction will process in 2 days because they're not sure what additional verification might be required. They can't guarantee that your documentation will be sufficient because the standards keep shifting, so they start using language that protects them from making promises they can't keep. Processing times may vary. Additional verification may be required. Please allow extra time for review. This language sounds reasonable, professional, cautious. But to customers, it sounds like uncertainty, like the institution doesn't know how its own procedures work, like the rules are made up as they go along. Here's the part that creates the real damage. When people lose confidence in an institution's ability to predict its own behavior, they start making worst-case assumptions about timing. If the bank says allow extra time, people assume that means maximum time. If they say additional verification may be required, people plan as if it definitely will be required. This brings us to the psychology of what happens before panic. Most people think financial stress creates two states: everything's fine or everything's falling apart. Confidence or crisis, trust or terror. But there's a middle state that's much more common and potentially more destabilizing. Cautious uncertainty. People don't stop using banks when rule drift begins. They don't pull their money out or close their accounts. They don't make dramatic changes to their financial behavior. Instead, they make small, logical adjustments that collectively change how the system functions. They keep more cash on hand just in case. They submit paperwork earlier than necessary just in case. They avoid transactions near weekends or holidays just in case. They choose simpler banking products over more complex ones just in case. Each individual adjustment makes perfect sense. Each one is a reasonable response to increased uncertainty about timing and procedures. But when millions of people make these adjustments simultaneously, the cumulative effect changes how money moves through the system. Cash sits idle longer. Transactions cluster around certain days of the week. Simple products see increased demand while complex products see decreased usage. Processing volumes become less predictable. Banks notice these changes. They see cash balances rising. They see transaction patterns shifting. They see customers choosing simpler products. And they interpret these changes as signs that they need to be even more careful. More verification, more documentation, more enhanced procedures, which creates more rule drift, which creates more uncertainty, which creates more cautious behavior. The cycle feeds itself without anyone making a conscious decision to create instability. This is how trust erodes before anyone admits there's a problem. This is how systems become fragile while still appearing to function normally. So what does this mean for how you think about financial stability? The traditional warning signs of financial stress, bank failures, credit freezes, market crashes, are late-stage symptoms. By the time you see those headlines, the underlying erosion of confidence has been building for months or years. The early warning signs are much more subtle. Longer processing times, more documentation requirements, less predictable approval timelines, more cautious language from institutions about their own procedures. These changes don't feel dramatic when they happen. They feel like minor inconveniences, small adaptations, reasonable responses to an increasingly complex regulatory environment. But they represent something more significant: the gradual breakdown of the predictability that makes financial systems useful. When you deposited that check on Friday and knew it would clear by Monday, that wasn't just convenience. That was confidence in the system's ability to behave consistently. When that predictability disappears, even if the system still technically functions, something essential has been lost. Understanding this pattern doesn't give you the power to prevent it, but it does give you the ability to recognize it early, before the uncertainty becomes widespread enough to create the kind of feedback loops that turn minor friction into major instability. The question isn't whether your bank will fail. The question is whether you can still predict how it will behave. And when the answer to that question becomes uncertain, everything else becomes uncertain too.